time for Under 30. You're watching Next Gen Investing here on the Schwab Network. I'm Alex Coffey, and I'm now joined by George Tsilis, Senior Markets Correspondent for the network. And George, we come back to a name we've discussed many of times. That's Joby Aviation. But it's almost a crossover to one of your other favorite discussion topics, which is these companies floating stock in some way or another, and why that's a risk. So why don't you walk through why this stock's down, 8% now, but even it was over 10% earlier?
Yeah. So we talk about this all the time, especially with businesses like Joby and its competitor Archer Aviation, which are going to be moving into the market for electric vehicle takeoff landing. In other words, the air taxis or air helicopters, if you want to call them that, or put them in that same sort of product category. But nonetheless, we do talk about how they're looking for FAA approval to begin deploying their technologies. We talk about Joby quite often in terms of what they're looking at in terms of sales going forward, and when they're going to actually start, producing and selling their electric vehicle takeoff and landing, vehicles, if you will. So, nonetheless, looking at the sales last year, which may be some licensing agreements, they generated around $100,000. Market capitalization $16 billion as of close yesterday. They are expecting to achieve sales more than $250,000 this year. Next year is when they're expected to sort of move up the ladder in terms of progressive sales to close to 28 million. Now, with that said, the company's stock price is up 200% this year, and we talk about the product prospects and even the partnerships that this company has with companies like Toyota Motor Corp, which is investing in these companies. A lot of the Arab Emirates states in the Middle East are starting to deploy these technologies. And again, they're looking for FAA approval in the United States. But when prices move higher, and we talk about the dilution risks of stocks like this, that happens to be the case today, because the company did offer $514 million in equity. Now, when you put that in percentage terms relative to the market cap as of close yesterday, it's roughly 3 to 4%. They're adding to that in terms of the decline because there's also sort of a news headline that was speculative. And I'm going to emphasize speculative because yesterday there was a teaser, in terms of what Tesla was going to unveil. Some speculated, again, that they would unveil some sort of, electric vehicle and takeoff and landing module like what Archer and Joby are bringing to marketplace. But that wasn't the case yesterday with Tesla. They announced, of course, a cheaper Model Y and Model 3. But nonetheless, I think that the dilution today, as well as maybe some of the fears associated with Tesla now potentially moving into this market, is creating some sell-off today.
All right, George, this is more of a discussion topic on this cohort of stock, which is sort of the pre-revenue discussion. So obviously you highlighted the risk of the stock equity floating and how that can impact dilution and impact things. But just from a stock performance standpoint, George, I want to understand how someone who thinks a little bit more long-term can balance the rally happening before the revenue's there. Oklo is another example in a different industry. Like, at some point, a lot of optimism is priced in here, George, and to me, it just leaves a lot of runway for disappointment.
Yeah, so it's very challenging. So Oklo, which is, of course, the nuclear company, they're not expecting sales in 2026. So that's a different story altogether. But their yield looks relatively good in terms of what they'll generate if they bring it to market. Now, if you look at companies like Joby and Archer, so I'll stick with Joby since we're talking about it primarily, they're projected, they're already generating some revenue, so that's important. The second thing is they're projecting a pretty significant increase in revenue next year. So it looks like, just based on consensus guidance, a regulatory feel in terms of approval from the FAA, investments that are being made from local municipalities and local areas to basically able to host these vehicles. I could see this coming down the road because there's no reason why we can't have an electric type of helicopter that is utilized, like, for instance, police helicopters, ambulatory helicopters and so forth. So that makes sense. But the challenge is how far away are they? And the second is what their cash burn is going into the event of deploying their technologies and generating that higher rate of revenue. So all of these uncertainties create a lot of volatility. So this is a high beta stock, but the trend is still positive, irrespective of the decline we've seen in the last week and the decline today. So, for what it's worth, you can use sort of a longer term, moving average, maybe a 20-week moving average, which is effectively like a 100-day moving average as a benchmark line of support. And it could retest those areas, but it also just could continue from here, just from the fact that the company is getting closer towards more progressive sales. But the market cap relative to those sales, even on a forward basis, is still high. And so that's going to create some volatile events. And again, assuming the market doesn't pull back, you have to consider, again, the high beta nature of this name relative to the overall market as well.
And the stock floating is prudent. For a company that isn't generating revenue, it supports the ongoing business when possible if demand's there for the stock shares. So not surprised to see it. We've had that conversation a lot. George Tsilis, we'll leave it there.